Hello, everybody. I know we're a dot 3 o'clock, but we'll give everybody another 5 minutes to start trickling in. But if you're here and you're early, thank you so much for joining us. My name is Shruti Gurudanti. I am the chair of Rose Law Group's Corporate Transactions Division, and I'm very excited to have you all here. And selfishly, I'm actually very much looking forward to this presentation because I have a lot of questions about the one big beautiful bill. And I really truly want to understand what's in our OBA, and what it is that we can expect. We've had a lot of clients reach out to us asking for more information. So we partnered with the very amazing team over at Splaver Kasten CPA to help do this presentation for us. And those of you who are new to Splaver, who have not met this wonderful team before, please do take some time to listen, and of course look it up as well, because they are officially now our referral partners when it comes to CPAs, tax, and anything accounting related. So we do ethically, I'm responsible to disclose that we do have a referral agreement in place with compensation involved, but we highly, highly recommend them for any work that or any advice that you may be looking for in that area. As a quick introduction to folks who've not met me before, I head up the corporate transactions division at the firm, which means that I handle all of our corporate and business work. So if you're a business owner, you're an entrepreneur looking for support on any of your business and corporate transactions work, I would be the one helping you. And my core expertise is mergers, acquisitions, private equity, venture capital work. So if you're looking to buy or sell, I would be the one helping out. So all of our contact information should be available. But without me being in between you all and this amazing presentation, I will hand it over to Jennifer and Eric over at Splaver Kasten to take it away. Thank you.
Thanks, Shruti.
Thank you, Shruti. So we went a teeny bit out of order, but that's okay. So welcome, everybody. This is our welcome slide. We're so glad to have you here. We're going to do our best to cover the highlights of the law today. As we said in our introduction email, the vast majority of this law concentrated on individuals. It did touch slightly on business, and we'll cover that. But the vast majority of the presentation today will be with respect to individuals. While Shruti was speaking, we showed you our 2 required disclosures and disclaimers. So hopefully they were up long enough that compliance is happy with this and they won't yell at me later. They will review this. One for our CPA firm, in case you really want to read a lot, and the other one for our wealth management practice. Our agenda today is actually really simple. We'll talk to you a little bit about the background of what led to the new law. We'll talk about the effects to individuals. Then there is some overlapping legislation about individuals and businesses related to 1099s. We'll wrap with a teeny bit on business, and then we'll dive into some planning opportunities, as well as some reminders about things that you might want to think about that it seems like every tax season we go through and people just don't do, despite our recommendations to the contrary. So hopefully by your participation today and some of the slides that we've got together, you guys will see the value of these and use them going forward. Jen?
And so with that, we're going to dive right in. How did we get here? And I guess the easiest place to start is we got a new president, and he insisted on having a bill passed before July 4th or by July 4th. So the House of Representatives began working on the bill right away in January, and they passed their final version in May. That bill had a significantly larger projected increase to the deficit than the working bill on the Senate side of the chamber. So it moved forward in May. The Senate got the bill, didn't really like what they saw in the House version, and sat on it. And so they did that, and then they made their adjustments to the bill without any coordination from the House. And then finally, on July 1, the Senate bill passed on party lines, and the vice president had to make the deciding vote. And because there was no time between then and the July 4th deadline, the House of Representatives passed the Senate version as is on July 3rd, and President Trump signed it on July 4th. So what was the goal of this whole thing? And part of it was, President Trump in his first administration passed the Tax Cuts and Job Acts, the TCJA, in 2017. And most of those provisions took effect in 2018. Most of the provisions that impact business were made permanent in this law, in the TCJA. And then most provisions impacting individuals were scheduled to expire on December 31st, 2025. I think everyone's kind of heard of the sunset provision at the end of 25. So, and then there were certain provisions in the TCJA that were never intended to take effect. For example, the drop down in the bonus depreciation went from 100 to 80 to 60, etc. And then the implementation of the R&D capitalization. So the ultimate implementation of the R&D capitalization rules had a massive adverse impact on the American businesses, as did the step down in the bonus depreciation. And so they wanted to correct that and do away with those items. Because the intent was never for these to get triggered, unwinding it was, one of the main goals of this new OBBB. And then also he wanted to unwind many of the provisions of the Inflation Reduction Act, which was put in place by Biden. So items affecting individuals. So basically what he did is he extended and made permanent most of the provisions from the old 2017 law. Again, there were items in that law that were to get modified or altered, and they were never intended to go into effect, but they did start to go into effect, and so he wanted to unwind those. He also wanted to remove any of the green energy tax incentives passed by the prior administration under the Inflation Reduction Act. And he also wanted to fulfill his campaign promises, i.e., no tax on tips, no tax on overtime, no tax on Social Security. So we're going to dive into those things a little bit further and see if he really succeeded in those items. Okay, so the permanent items. The permanent extension of the individual tax rates. So he kept the tax rates at the 10, 12, 22, 24, 32, 35, and 37, as opposed to, Eric, if you want to jump to the next screen, as opposed to doing the multiple layers of brackets that we had under the old law. So you can see, just some minor differences in here. The 10% bracket pretty much stayed the same. The top bracket, though, now is 37. It was scheduled to go to 39.6 and to encompass a much larger group of individuals. And then if you notice, the 35% bracket currently encompasses a large group of individuals, whereas had the law sunsetted, it would have just been a very small group of people. So you can see the differences in the tax rates under the two different laws. So the couple other things that he did in here was he permanently repealed personal exemptions. And the child tax credit was extended permanently. It's going to go from $2,000 to $2,200 per child after 2029. But for right now, from 25 to 28, this law increases it to $2,500 per child. And those are the children that are under the 17 years of age. He did a permanent increase to the phase-out threshold of 400,000 married, filing joint, 200,000 single. So basically what that means is that your child tax credit is going to start phasing out at 400 MFJ or 200 single. So he kept that increase, that phase out increase permanently. He did a permanent extension of the doubling of the standard deduction. And so it does, I mean, so this was kind of twofold. It did have the desired effect of simplifying tax returns for some taxpayers because they don't have to worry about tracking deductions for itemized deductions. They just can take the standard deduction. But with the addition of QBI, and we're going to talk about that a little bit later, and other complexities, it made it more difficult for others trying to figure out itemized versus standard. So we've got that. And then again, starting in 25 to 28, the standard deduction increased $1,000 for single and $2,000 for married filing joint. So.
Oops, sorry.
And then we had, again, in this act, the permanent suspension of miscellaneous itemized deductions. And things like that are unreimbursed business expenses that are including travel and home office, maybe automobile usage, that W-2 employees it continues to not be deductible for them. And we want to stress that because we get a lot of questions on, well, can I deduct my mileage, or can I deduct this? My employer didn't, pay for them. No, unfortunately, as a W-2 employee, these types of deductions are suspended permanently. So you should seek reimbursement from your employer for these types of items because they are deductible items for your employer and they would be excluded from your income. So, if you're not going to get a deduction for them, try to get reimbursed from your employer. Some of the other things on miscellaneous itemized deductions that were permanently suspended are things like your investment advisory fees, safe deposit box rentals, tax return preparation fees, estate planning fees. All of those items are still permanently suspended. Just a little thing to point out, if you are a self-employed individual, some of these items are probably still deductible for you. We did that.
So
Sure.
to continue on with individual changes, we had fairly significant changes to the mortgage deduction rules with the TCJA. It reduced the cap on the most we could borrow from and deduct the interest against from $1 million to $750,000 as well. We used to have a provision that allowed us to have up to $100,000 of home equity loan debt and deduct the interest on that. So our real cap was really 1.1 million. There was some hope and some expectation that the $100,000 HELOC availability deduction would get added back. It did not. So as of now, we're capped at allowable mortgage debt of $750,000, no longer the million. And that would be on both a primary and second residence combined if you have a second residence. I will add one of the things that we also see, it's not on the slide, but the way mortgage interest deduction works is the most you can deduct is what your mortgage starts with originally. So if you start at $750 and you amortize your loan down to $500,000 and you do a refinance to $600,000, you're only allowed to deduct interest up to the last balance before the refi. The only time you get the additional interest is if you spend those additional dollars that you pulled out to improve the property. Getting back to, oops, sorry. That was so exciting. I know you want to see that slide, but you have to wait a second. Primary mortgage insurance actually went away in 2018. It's back again, starts in 2026. It's got a very, very narrow phase out window. It starts at $100,000 of gross income and is completely gone at $109,000. So for those lucky people that have under $100,000 of gross income and who have PMI, you'll be able to deduct that as interest expense. One of the most controversial items in the code changes from 2017 was what we call the SALT deduction, the state and local tax deduction. This had a huge effect on people in states with high tax rates. The cap was $10,000, This law increases it to $40,000, but it also introduces a phase out. So once your modified adjusted gross income hits $500,000, it begins to phase out through 600,000. I'm going to bounce to my fancy little table so you can see. So if your modified adjusted gross income is 0 to 500,000, you get no SALT phase out. As your income goes up, you can see in $10,000 increments. By the time you get to 600,000, you are back again capped at $10,000. So we have no control over this, obviously. Your income is what your income is. You can, to some degree, affect your modified AGI through deductions in your business, through 401k contributions and things like that. And we do have a definition of modified adjusted gross income. I'll put it up at the very, very end for anybody who's really interested in reading it while we're doing questions. This is scheduled to, the phase outs are scheduled to increase 1% a year, not very much, but it will lock in 2033. And from that point will be roughly $46,000 will be the cap. Another item that was extended, excuse me, was the permanent extension of casualty and theft loss. This is a pretty big deal for people who suffer theft loss, which is, there's no shortage of fraud in our country. Those deductions literally went away with the 2018 law. You can have a casualty loss as long as your casualty occurs in a federally declared disaster zone and during the period in which the zone is identified. We've seen any number of people try to pursue theft deductions since 2018. And we think, we don't know, you never know what motivates the IRS, but the IRS did issue some favorable guidance on when a theft loss may fall under what we commonly refer to in the profession as the Madoff rules. So the IRS issued regulations when the massive Madoff fraud occurred and gave us sort of a waterfall of analysis to determine whether or not you could take a theft loss deduction. They've sort of piggybacked on that. These rules are far more opaque, way more complicated to interpret. We're hoping they're going to give us a further expansion of the explanation sometime in the future. In the meantime, we have sort of a garbled mess. If you've suffered a theft loss and you have an open statute of limitations on a return, roughly 3 years from the later of the due date or the extended due date of the return in question, then it would be worth having your tax preparer look at your facts and circumstances and see if they can't get you into that deduction. Finally, another one of the important changes for individuals was the permanent extension of the estate limit caps, known as the exemption amounts or the unified credit. Those are sort of synonymous. The death limit today, if you will, is $13,990,000. They statutorily increased that to 15 million starting January 1 of next year, and it is indexed with inflation. So in the absence of this change, we would have rolled back to $5 million, which what the limit was under the old Obama rules, never changed by the Biden administration tax law. Indexed with inflation, it would have been about 6.7 million. So if you're a high net worth individual and you were worried about estate taxes, you have a much bigger number to work with. So some of the individual provisions, these are the election promises. No tax on overtime. Married filing joint families can take up to a $25,000 deduction. You have to have qualifying overtime. We know that constitutes the half portion of time and a half. The IRS has been charged through the statute with identifying other definitions other than just half of time and a half. And so we are dependent on them to issue regulations to tell us what that means. As of now, the only guidance we have is the half portion of time and a half. This change and this deduction are temporary. They're designed to last for the duration of the Trump administration. 2025 through 2028 goes away. It's capped for highly compensated people at 160. Of course, the reality is most people who earn 160 are salary and exempt from overtime anyway. It's available to both standard and the people who take the standard deduction and people who itemize. does phase out if your combined gross income, if you're married, exceeds 300, if you're single, 150. And if you're married, you cannot file separately in order to take this deduction. You have to file jointly. Interestingly enough, for those of you that don't follow, the IRS is currently on their 8th commissioner this year. We're at a world record. That's on average one a month, although we did have one last about 6 days. And so to say it's chaotic over there would be an understatement. They did announce on August 2nd that they do not intend to change the withholding tables for W-2s for people who are eligible for this deduction or the tip deduction, which Jen will talk about in a minute. So we're not really quite sure how it is we're going to identify the amount of eligible overtime. The expectation was it would be at the W-2 would be modified. They would add an overtime box and they would effectively place the burden on the employer to determine what was qualified overtime based on the ultimate definition. Right now, we have the one, and we have no clear vision yet as to how it is taxpayers or we as preparers are going to be able to identify the appropriate overtime amount. Jen?
So his next promise was no tax on tips. Again, this was an up to a $25,000 deduction for qualified tips in certain occupations, which at this point has not been defined yet. It needs to be defined by IRS regulations. So we are, waiting for those regulations to come out. Although commentary has been that it's going to be occupations that normally have tip income, servers, taxi drivers, things like that. Again, this is temporary, only 25 through 28 during the Trump administration. You cannot negotiate a revision to a normal price. And so what that means is, if the normal price is say $100, you can't go back to the person can't come to you and say, okay, let's say that the price is really 75 and $25 of it is a tip, so that they can exclude that tip income. So you can't negotiate on price to get tip included in there. It's available for both standard deduction and itemizers. Phases out when your gross income exceeds 300 married filing joint, 150K single. And again, if you're a married taxpayer, you have to file a joint return to claim the deduction. You can't file separate returns. So reporting wise, employers and other payers are going to be filing informational returns with the IRS or the Social Security Administration and furnish statements to the taxpayers showing the cash tips that were received and the occupation of the tip recipient. Again, we're wondering how this is going to be accomplished because they've said that they are not revising the W-2s for 2025. So we'll have to see, how that one turns out.
Probably the most, I hate to use the word misleading when it comes to politics, but certainly the most misleading change is the no tax on Social Security. And our friends in the Social Security Administration certainly didn't do the CPA community any favors by sending a letter out shortly after the law was passed, effectively telling people there was no tax on Social Security. At least that was the interpretation of at least the 15 or 20 people who emailed and called our office. That is not the case. If your income is exceptionally low, it may very well be the case, but the general gist of it is almost certainly if you're a client of our firm, you're going to pay tax on some portion of your Social Security, perhaps all of it. The way the deduction works is it is $6,000 per eligible individual who is age 65 or above. So if you have a wife who's 67 and a husband who's 62, that'd obviously be one in a joint return. You get one $6,000 deduction. If you're both 65 or older, you'd get a full 12,000 at least to start. Once your AGI hits $150,000, we start to phase out of the deduction at a rate of 6% per thousand. And so at $100,000 increase or $250,000 of taxable income for a married filing joint couple, you've completely phased out of the 6,000. A simple example would be for a single person the maximum income is 75. If they had 100,000 of modified gross income, they would be 25,000 over. 6% of 25,000 is 1,500. So they would only be able to deduct 4,500 of their $6,000 starting number. This also is eligible for both itemizers and non-itemizers, and like the other campaign trail promises, is available only for 25 through 28. I will add that this has no impact whatsoever on what's already been embedded in the code, which is the additional or extra 1,600 per individual once you hit age 65.
And then all right, so then another one is no tax on car loan or a new no tax on car loan interest. So you get a deduction for your car loan interest. The maximum amount you can deduct is $10,000. The qualified interest is on a loan that has originated after December 31st, 2024, and you have to purchase a personal use vehicle, and it has to start with you. So then that means it has to be a new auto that you're purchasing. Again, it has to be for personal use, and it has to be secured by a lien on the vehicle. A qualified vehicle is a vehicle, a car, a minivan, an SUV, pickup truck with a gross vehicle weight rating less than 14,000 pounds and has undergone final assembly in the United States. The phase out starts at 200,000 for a married filing joint, 100,000 for single. And again, it only runs for the 2025 to the 2028 tax year. So when you talk about a qualified vehicle, what does that mean? Final assembly has to be in the United States. So you should be able to get that information from the dealer that you purchased the car. It should be it's an information label on each vehicle. Or alternatively, there is a website that you can go to and you plug in the vehicle, the VIN number, and it will tell you whether that has undergone final assembly within the United States. They call it the VIN decoder website. And that we've listed what the website is right there. So you can log into that and it'll tell you if your car meets this qualified vehicle definition. It is eligible for both itemizing and non-itemizing or standard deduction taxpayers. And you do need to include the VIN on your tax return in the year that you are claiming the deduction. Lenders or other recipients of the interest must file information returns with the IRS and furnish statements to the taxpayer showing the total amount of interest received during the year.
I'll add, I would expect what will happen here is, much like we had the list of eligible EV vehicles for credits a few years ago, we started with a link to a website similar to this, hard to navigate. You had to know the VINs, so you couldn't do research in advance. It only took several weeks before people started compiling lists and putting them out on the web of eligible vehicles without having to go through the VIN decoder. As of yesterday, I couldn't find any, but I would imagine we'll be able to find some soon. I did find some for manufacturer specific sites. For example, I found a Ford dealership that had a list of all of the vehicles they were offering and where those were final manufactured. So I expect that in relatively due course, we'll be able to do some due diligence on, what was final manufactured or final assembled here. Big changes, well, maybe big changes depending on your life, fairly big changes in the charitable giving. For one, no discussion that I've heard out in the general public, but we do have a new floor on itemized deductions for charitable contributions, and that is 0.5% of your adjusted gross income. So if your adjusted gross income is $300,000 and you donate $1,501 to charity, your first $1,500 or 0.5% of 300 is not deductible anymore. That's gone. Just like medical works in the top part of the itemized deductions, where the first 7.5% of your out-of-pocket medical doesn't count against your, measured against your AGI. Same here. So this is new. Congress did add a new itemized deduction for charity for people who do not itemize and who are taking the standard deduction. We did this also with the CARES Act during COVID, gave people a new deduction. It was $300 then. They've made it $2,000 per individual, $2,000 married joint, $1,000 single. That starts next year. It too is subject to the 0.5% phase out. And I will add that if you use a donor advised fund or a private foundation, you cannot take the deduction for those types of contributions. In addition, we have a new credit. Oh, excuse me. We have a new credit of up to $1,700 for taxpayers for donations to organizations that provide scholarships to private or religious schools. So this reads very similar to the Arizona state tax credits we have right now for tuition organizations. We'll get guidance from the IRS on this. And I think that's why they waited to make it effective for 2027, so they could properly define what these organizations are. We don't know how this will interact with the state, but right now, the reading of it would be you'd effectively get 2 credits for the same donation. You'd get a $1,700 credit on the Fed and a $1,700 credit for the state. And I'll remind people that if you take a credit on the state historically, or for 25 or 26 before this kicks in for the Fed, you do not get an itemized deduction for it on your federal return. In addition, another one they didn't talk about, they only talked about the good stuff, not the bad stuff. If you're high income and you happen to land in the 37% bracket, Congress introduced a new phase out on itemized deductions. And that phase out is 2/37. The goal here is trying to get you back only allowed to deduct 35% of your itemized deductions. So, so you lose 2/37 of all of your itemized deductions. It's a very bizarre calculation. I think we're interpreting it right. There's a ton of confusion in the community, our community. I've looked at a couple other papers put out by CPAs. It seems like our interpretation is similar to theirs. And the calculation is you actually take your taxable income, add your itemized deductions back, and then you multiply that by 2/37. So you lose about 5.4% of your itemized deductions. So it's a fairly significant hit. And this is on top of the 0.5% limitation that you're already going to experience on your charitable contributions. This starts next year. So I'm going to bounce really quickly to a different slide, and I'll come back and finish the last 2 items on this, because I think while I'm talking about the 37% cap and the 0.5, I've got some helpful thoughts, I think. So this is a strategy that we actually started using with the new law when the standard deduction doubled. And this is clearly a high income family example. We've got plenty of these in our book of business. I also have another example of a more average Maricopa County family, if you will. But in this example, you can see in these first 4 years, there's no donation bunching. And in each of the years 25 through 28, we have the scenario where somebody's donating $30,000 a year. Starting in 2026, you can see starting in 2026, you can see the 0.5% reducing donations. 5,000 of is 0.5% of a million. And then on top of that, the 15,400 deduction is the 2/37 adjustment. And so when all is said and done in years 26 through 28, this taxpayer actually ends up with allowable itemized deductions of under $20,000, which really takes them to having to use the standard deduction. Total tax for those 4 years using this scenario is $1,221,000. If instead you had the resources and you contributed $120,000 in 2025 and just decided you're going to skip the next 3 years, so your total contributions are the same, there's no 0.5% limit in 2025. There's no 2/37 limit in 2025. So you get your full $130,000 deduction, which takes your taxable income far smaller than the 2025 in the initial scenario. And you can see in the subsequent 3 years, you're still getting the same standard deduction of 31.5. And so as a result of bunching your contributions into a single year, you pay $1,188,000 in tax, which is a $33,300 savings. Or the way I like to think of it is, for this type of individual, a full additional year of contributions basically being paid for by the federal government. We do get objections to this, and usually what people say is, hey, I'd rather keep that. I'd rather do 30 in year one, keep my 90 for the next year, do 30 out of that, keep my 60, do 30 out of that, and then do the final 30. I think I can earn more on that money by keeping it and then deducting it later than the value of this approach today. And so I guess the question is, does that make sense? Are they right? And what rate of return would you need to offset the tax savings of 33.3? If anybody has any idea or wants to throw a number, I would love to see it thrown into the chat before I reveal it. Chris Reed is pretty smart. All right, so let's see. 8% would produce 14,400. That's not 33 grand. 12 would yield 21.6. That's not 33 grand. 18.5 would yield 33 gross. If you're in the 37% bracket, so if this was ordinary income, interest, or regular non-qualified dividends getting taxed at, interest getting taxed at 37, you'd really need 29.3 after tax to get 37. If it's capital gains, I didn't put it in here, but you'd need about 24.5% annual rate of return to realize 33%. So that ignores state taxes. Arizona taxes are 2.5% now. They're pretty low. If you're in a high taxing state, like we got a lot of clients in California, that would further, push the conclusion that maybe it makes sense to employ a bunching strategy if you have the cash. Sometimes we hear clients say, well, you know what? I really want to spread my donations out. I don't want to give 120 grand in one year because charities need money every year. And so one of the ways to take advantage of that is through a donor advised fund. These are a relatively new vehicle. They've been around a really long time, but they've been commoditized now, and you can find them through any number of brokerage houses. And what a donor advised fund is effectively a nonprofit that you set up for yourself. You contribute your dollars, you take your tax deduction in the year you make the contribution. So if you put 120 grand in 2025, you would take the full deduction this year, but you are in control of when those dollars actually leave the fund and go to your designated charity. So you could do 120 this year, send 30 out, or you could send 30 directly and do 90 this year into the fund, and then do 30 in each of the 3 years using our example, and accomplish the same objective. So we really like this idea. It's a pretty good chunk of money. If you're a more typical family in Maricopa County, we've got a lot of clients in the $150,000 to $500,000 income range. And I just sort of layered in a really similar example here. Same thing, except I swapped my columns. So here we've got somebody who's doing 15,000 euro donations for 3 years, 45 grand in total. If you bunch that into year one, I'm going to do this quickly since I spent so much time on the other. You would end up saving $6,500 in tax over 3 years. So is it worth it to you to save $6,500 in tax? You could make that decision. We're not here to tell you what rate of return is important to you. In this case, you'd need about a 19% return in order to get for the subsequent 2 years in order to get the same result at the same tax rates we just talked about. Jen?
No, but you got to go back to your slide to finish up the.
Thank you.
You're
It's been correcting me for 35 years. So we've had some changes to 529 plans. Starting in 2026, we've increased the amount that you can contribute now to kindergarten through K-12 from 10,000 to 20,000 a year. The definition has been expanded to include secondary, private, religious schools. Actually, religious schools were in there. There was some debate about private. Most people think it was eligible, but this legislation clears it up. They also expanded eligibility. So educational therapies for students with disabilities, with dyslexia, things like that, that has now been added. Dual enrollment fees, if you have a child in high school who's enrolling in college, that tuition is now eligible. And if you just happen to be foolish enough to want to be a CPA one day and you have to sit for the exam, then your fees for the exam and a prep course, if you need it, would also be deductible, or the bar if you're really foolish and want to be a lawyer instead. And then we don't see a lot of small business stock in our practice, largely because it requires investment in C Corps, but there was an expansion in the deduction for qualified business stock. And I think we have a teeny bit more on this later. Do we not, Jen? I think we do, but I'm not sure. Anyway, it used to be you got an exclusion at 5 years of ownership subject to alternative minimum tax, which really bit people in the rear end. This rule starts the exclusion at 3 years, 50%, 75% after 4, and 100% after 5. Your gain exclusion is capped at 10 million. I will not feel sorry for you if you get a $10 million gain exclusion and have to pay tax on the excess, but I'll be very happy for you.
All right, so the next promise that he made was the repeal of the clean energy credits. And so that did happen. But you do still have a little bit of time. For the used electric vehicles, you have until September 30th of 25 to purchase one. For a new electric vehicle, you again have until September 30th, 2025 to purchase and still get the credit. The energy efficient home improvements are repealed after December 31st of 25, and so is the residential energy credits. So we went into a little detail down there about what the energy efficient home improvement credits are. It has to be to your main home only, and it's got to be certain qualified expenses. And then we've listed out the amounts there that would qualify. And just, to reinforce, they do have to be installed, placed in service, and paid for by December 31st. The solar, which is the residential energy credit, again, on your main home only, it is for solar electric, solar water, geothermal heat pumps, battery storage, etc. This is a great credit. It's 30% of the cost. So there's no limit on that. So it can be a pretty good credit deduction. But again, it must be installed, placed in service, and paid for by December 31st. If you have it installed, you've placed it in service, but you've only paid for part of it by December 31st of 25, you will get the credit on the amount that has been paid for by December 31st, 25, not the additional amount that you're going to pay after December 31st of 25. And so this is there's been a lot of talk, I think, about this one is the Trump accounts for new children being born. They have to be born in 2025 through 2028. So it's the remaining part of the Trump's administration. And for those children that are US citizens and they have a social security number, the US government will deposit $1,000 into this retirement account. That is intended to function very similarly to an IRA. These accounts can be claimed through a bank or some other qualified financial institution. It allows you or anyone really to contribute $5,000 after tax to this account. And those contributions start after, I want to say, July 26th. So there's a little bit of time before that kicks in where you can start making the contributions. It can be funded by parents, relatives, governmental agencies, taxable entities, etc. There is a caveat if it is if contributions are made by the state, a 501c3 organization, or the Secretary of the Treasury, the $5,000 annual limit might be waived if they meet some certain other requirements. The funds have to be invested in a qualified mutual fund. And that is a fund that follows either the S&P 500 stock market index or another index that's comprised of equity investments primarily invested in US companies. And for regulated futures contracts that are traded as a qualified board exchange. So it could be a mutual fund, it could be an ETF, but the key concept is it has to be primarily invested in US companies. Employers can contribute up to $2,500 per year for their employees, but it does count against the $5,000 limit that can be contributed each year. That is not taxable income to the employee or the recipient.
Yeah, and I'll just add that I'll answer that question in a second, Mr. Humphreys. So they use the term qualified mutual fund, but a mutual fund or an exchange traded fund is eligible. We're waiting again for a broader definition from the IRS on what constitutes an index. What we think is it's going to be the S&P 500 index, a NASDAQ 100 index, a Russell 2000, maybe a Russell 1000. My gut is those would all qualify. Likely that's about it. Those are all pretty broad based. You're probably not going to be able to buy the T. Rowe Price blue chip stock fund. Probably. The IRS will tell us, I guess, whenever they get around to it. This is pretty complicated, which is again why they, I think, waited till mid-year next year to allow people to open accounts.
Okay, so again, the earliest time that you can start funding these accounts is July of 26, so about a little less than a year from now. Contributions have to cease once the child reaches the age of 18. No distributions are allowed until the child reaches the 18. And once the child reaches 18, then the account is treated like a regular IRA. So the account will grow tax deferred until the commencement of withdrawals. And it generally follows the IRA rules, which means that if the beneficiary is under the age of 59 and a half, an early distribution will be subject to the 10% penalty, just like regular IRAs are. And the penalty applies to net of the after-tax contributions.
Yeah, so, and there would not be a penalty for eligible distributions,
Right.
and those are listed there. Higher education. Sorry, Jen, I stole your thunder.
It's okay.
I'm sorry.
So that's okay. There are some early distribution exceptions. They're listed there in the chart. Again, how distributions are going to be taxed is unclear right now. We just need to wait for issuance of regulations from the IRS to understand and execute appropriately. So 1 year to deliver that information to us.
Yeah, the thought here is that these are intended to function like IRAs. They are not IRAs, nor are they an IRA replacement. So one of the question we received is this a Roth? It is not a Roth. It is a separate account, separate from a traditional or Roth. So if you have an IRA, whether it's traditional or Roth, funding this for a child is separate entirely. I will add, if you intend to fund a child's education, your contribution amount is in the $5,000 range, you might want to consider whether or not you utilize this account versus a 529. 529s are exclusively for education, and although you do have flexibility in terms of who you point the account at, so you could, I can assign it to my daughter when I build it, and if she gets a full ride scholarship, I can just point it to my son, and if he gets a full ride scholarship, I can point it to a nephew or a niece or a cousin. You have flexibility that way, pretty much any relative. But if you exhaust family and you end up taking those funds out, those distributions are subject to a 10% penalty plus tax on the growth at ordinary income rates. This will, we think, be treated like an IRA. And so you could pull funds out without penalty, we think, for education. It's pretty clear in the statute that you can. And so you have way more flexibility if you don't use it for education, and you can't point it at somebody else, but if you don't use it for education, you could distribute it for a first time home. You could use, we don't know what small business expenses are yet. That's going to be crazy. But I think you have way more flexibility, and effectively it just turns into an IRA, notwithstanding the name, and you'd be able to access it 59 and a half. And if you had to access it earlier, you're subject to the same exact penalties you would be subject to under a 529 anyway, which is the same 10% penalty for early distribution plus ordinary income tax, we think, on the growth. So, if you're thinking about funding a 529 and that amount's going to be $5,000 or less annually, I would think about this. If it's more, I would fill this up to the tune of $5,000 and put the rest in the 529. And then I would eat the 529 first when it was time for consumption and preserve this. Excuse me a second. Sorry. So we do have significant changes to 1099s. The tax law that had been in place that would have taken effect starting next year actually would have made the issuance of 1099s far broader at the same $600 level we have now. The nice thing about this is the threshold for issuance now will be 2,000 starting next year, and it does apply to both kinds of 1099s, NEC, that's almost always issued to independent contractors, and the MISC 1099s, which are issued to lawyers, because I guess Congress doesn't trust lawyers, so they have to have their income reported. I don't know why. Medical practitioners and rent, primarily. Those also, if you win a slot jackpot, that falls under the prizes and awards. The big change is this, which is that if you happen to use a platform that, an eBay type of platform or something like that, and you just casually want to sell personal items under the old law and through the end of last year, 1099s were required for gross proceeds of $600 or more. So if you sold household furniture, if you sold who knows what, it doesn't matter. Anything in excess of $600, you got a 1099, which means you should have included in your tax return, and if you didn't, you're almost certainly going to receive a notice from the IRS. So this law increases the threshold to both $20,000 total and 200 transactions retro to the beginning of the year, and it's only required if those thresholds are met. So this should result in only people who are actively engaged in trade or business using these types of platforms to get 1099s, and not people who are casually using them. Sure, let him ask the question.
So items affecting businesses. So we have some favorable changes that happen for property and equipment. 100% bonus depreciation is back, and it was made permanent, so that's good news. For 2025, it was currently scheduled to be at 40% under the TCJA. So they've now restored it back to 100%, but it's only for property acquired and placed in service after January 19th of 2025. Substantially all personal property qualifies, land improvements and most leasehold improvements will qualify as well. Section 179 expensing cap was raised from 1.25 million to 2.5 million. And the phase out is starting at 4 million for every $1 of Section 179 over the $2. Of 179 for each $2 over the maximum limit. So if it's for every $2 over 4 million, your 179 expense reduces by 1, is an easier way to look at it. You do get 100% deduction from manufacturing production facilities. I just want to talk about that real quick. I don't know how many people that might apply to, but it applies to non-residential real property that's used as an integral part of qualified production property. So if you have administrative offices or, something that's not an integral part of the production, that piece of the property does not qualify. The original use has to begin with you. And there are depreciation recapture rules if it ceases to be used as the qualified production property within 10 years of it being placed in service.
So that limitation was put in to stop people from gaming the system, right? Stop people from saying, hey, I'm in the manufacturing business, and they manufacture widgets for 3 weeks just so they can put their business in there and then pivot, to their CPA business as opposed to manufacturing. This forces a recapture of that accelerated depreciation. I will add that with the 100% bonus depreciation back in place and Section 179 raised, if you're acquiring real property, you should consider whether or not you want to undertake a cost segregation study on that property. If you don't do a cost segregation study and your property doesn't meet the manufacturing production facility definition, which we're waiting for, that commercial property will get a flat 39-year life. What a cost segregation study does is we help you typically. We'll help you engage an engineer who will analyze the plans of the structure. They'll look at your cost and they will actually carve the building up into its individual component parts based on useful life. And so, for example, land improvements, which would be your entire parking area, your blacktop, your sidewalks. That's 15-year property under tax law. That would fall under 100% bonus depreciation. Your electrical systems would fall under 15%. Your flooring, your window coverings, 7-year property, but 100% bonus depreciation. So you do have the ability to significantly carve your building up and rapidly accelerate your depreciation, if that's something that's of interest to you. We've had great success using these over the last couple of years, and not nearly as valuable 40% bonus depreciation that we would have had for this year, but with 100% bonus depreciation, it can be a game changer in terms of tax planning. So I'm going to just zip through this really quick because we only have 3 or 4 clients that experience the penalties of, if you will, the penalties of the mandatory capitalization of research and experimentation expenditures. So we've always called it R&D. Congress called it R&E for this. And basically what it said was, to the extent you have any research at all, you have to capitalize it and you have to write it off over 5 years. And you're limited to a half year of depreciation in the year of implementation. So this had a staggering effect on several of our clients, and everyone's very happy it got unwound. Congress actually, the House passed a bill a year and a half ago that the Senate had agreed they would actually pass. And then in the end, the Senate got mad at the House for doing something and tabled it, and it never made it through, unfortunately, for the president's signature. If you have foreign R&D or R&E in this case, that's still required to be capitalized, and it's required to be amortized over 15 years. So the theme of Keep It in America prevails through this change as well. We also don't have many clients that experience this. This also came into effect in 2018 under the TCJA, which basically said, we're going to cap how much interest you get to deduct, and your deductible interest is a function of your taxable income plus a couple other minor add backs. But it did not include an add back for depreciation and amortization. This law leaves a fundamental structure in place, but it does allow you to factor in depreciation and amortization, giving you a higher deduction. I don't think other than one client we've ever had anybody capped on this. So I'm going to move on. And then, boy, I kind of feel like I beat past serenity tax to death earlier, but I'll talk about it really quickly. The House wanted to disallow people who are in the profession of health, law, accounting, financial services, entertainment, sports. Basically, if you used your brain to earn your living, maybe sports aside, you weren't going to be allowed to use the pass-through entity tax. Our profession, I know the bar, both got heavily involved in trying to influence the Senate. When the Senate changed the pass-through entity tax rules, they did not adopt the House definition. This can be really valuable for our high income clients that have 600,000 more of modified AGI. You're going to be limited to 10 grand of state and local tax, and if you're not using pass-through entity tax, you're leaving tax dollars on the table.
Qualified business income deduction, QBI. This again was made permanent. The generally eligible businesses are allowed a 20% deduction of pass-through income subject to certain limitations. It can't exceed 200% of the wages paid by the pass-through entity and the unadjusted basis of its property and equipment. There are, again, some exceptions for specialized service trades or businesses, which Eric just kind of talked about. The phase outs did increase, though, from married, finally joined at 394 up to 544 600. So that range of phase out increased by went up to from 100 to 150 grand for SSTBs. And just real quickly, what an SSTB is are services that generally rely on the reputation of skill of the person performing those services. So again, I think what Eric pointed out was like health, law, accounting, consulting people. This change also allowed for a new $400 minimum QBI deduction that will be indexed for inflation over the years for taxpayers that have at least $1,000 of QBI and they materially participate in the business. So it does give, some people at least a bare minimum.
Yeah, so I was going to say, just to be clear here, what this means is if you are in the practice of law or accounting or you're a doctor and you have pass-through income, this is income that comes through an S corp or a partnership, and your modified AGI in your tax return is below $394,600, you're entitled to the full 20% deduction as long as you have enough wages in your entity to take the full deduction. So if you had, for example, $100,000 of pass-through income, that would allow you a $20,000 QBI deduction. You have to have at least 40,000 of wages to qualify. Once you get above 394.6, it starts to phase out.
And then by 544.6, you're completely phased out of getting the QBI deduction. Some other miscellaneous provisions. I'm not sure how many people this affects, but 100% disallowance of employee meal expenses. And so this is effective after the end of this year. So 1/1/26. Employers can no longer subsidize a company cafeteria unless you charge fair market value for the meals. And if you don't do that, then there's no deduction for the entire expense of operating the cafeteria. No deduction if the employer provides meals to employees because they are unable to obtain one, unless the value of the meal is included in their W-2. So an example of this would be like doctors and nurses who are on-shift employees who can't leave the premises to go get something to eat. And so the employer provides them something. Unless that's included in their W-2, the employer cannot deduct that meal. There is some relief for restaurant and catering people and offshore oil rig and gas platform workers and certain fishing workers in Alaska. So
Senator Murkowski got the fishing workers in Alaska, or she would refuse to give them her vote. So just a couple other provisions. We're almost done. Employers are permitted to, this is an extension, are permitted to make up to $5,250 of student loan repayments for their employees with student loans. This is sort of piggybacking on the employers being allowed to pay up to $5,250 of tuition each year for an eligible employee. you can actually include shareholders, owners, or their family members, but they can't receive more than 5% of the total assistance that is provided to the workforce that you actually provide the benefit to. I think we talked a teeny bit about qualified small business stock. I think I'm just going to pass on it because I don't think we have anybody that historically has done it. If so, give us a buzz. We're happy to talk to you about it. Opportunity zones were a really big deal in the Trump tax law, and they're pretty complicated. They're very complicated, and there's still confusion about how to adopt and implement and execute the law that started in 2018. This tried to clarify some of it. So I'm going to put a little table up here for you. So the old law started in January of 18, expires at the end of 2025. The new law starts in January 2027. So we have this gap year of 2026. And the reason for that is that if you invested in an opportunity zone at any time from January 1 of 18 through December of 2025, you're required to take the gain on that. You deferred the gain when you took the investment. You're required to recognize the gain on your 2026 return. So unless you sold the investment earlier, I'm not aware of any opportunity zones in our client portfolio that have exited yet. So at this point, anybody who did an opportunity zone investment through what will be the end of this year, or I guess if someone wanted to do it next year, although they wouldn't get a benefit, at least not immediate benefit on deferral, that tax would trigger on the 26 return. The first law gave you a step up in your cost basis of your new investment, equivalent to 10% of the deferred gain, not 10% of your investment amount, but the 10% of the deferred gain after 5 years and 15% after 7. Excuse me. This law removes the 15% after 7, retains the 5, but does add a 30% step up for rural funds. The rural definition is funky. If someone's interested, we can share it with you. And if you end up sitting on this investment, or actually the fund does, through 30 years, which is an extraordinary period of time, you actually get a full step up in basis of the investment in the opportunity zone to the fair market value on that date. Any gain after that would be taxed, but gain in years 0 to 30, depending on the quality of the valuation, would not be taxed. And then the Congress added a bunch of burden on the promoters of these for just a ton of reporting detail. So some important reminders and things that we see clients not doing. So for those of you that are maxing out your 401ks, are taking advantage of deferred comp plans through employers if they're available, and otherwise have available cash, the backdoor Roth is a beautiful thing. And you have to be careful because if you have an existing IRA, using a backdoor Roth can trigger tax. There are ways to navigate your way around that. And you would want to definitely talk to your advisor, or if you're our client, us, of course. But the ability to stack 7 or 8,000 now if you're 50 or above, 70 if you're younger, 7 or 8,000 a year on top of each year for many, many years, compounded, effectively tax-free into perpetuity, is a beautiful thing. And we would encourage anybody who's investing in a taxable account to think about using a backdoor Roth strategy. We still have clients not taking advantage of pass-through entity tax. Talked about it earlier. I'm not going to talk about it again here, but if you have a pass-through company and you're going to phase out of the new higher SALT deduction limits, you definitely want to think about whether or not you want to take advantage of pass-through entity tax. And another item that we see all the time is, with the new higher standard deduction, many people are no longer itemizing. And so people who donate money to charity are really not deriving a marginal tax benefit from it. And if you want to avoid tax on a gain on an investment, appreciated stock, you can donate that appreciated stock to a charity. You never pay tax on the gain. And if you're itemizing, you still get a deduction for the fair market value. So if I invested $10,000, well, I'm not going to use NVIDIA because that's crazy. If I invested $10,000 in Amazon 5 years ago and it's worth $25,000 today, I can donate those shares to a charity. I never pay tax on the $15,000 of appreciation, but I get a full $25,000 deduction. Additionally, and this has been out for a really long time, we try to remind people every year in our annual letter, but if you're 70 and a half, and again, you're not itemizing, you are absolutely leaving tax dollars on the table. So you can make what's called a qualified charitable distribution, which is a direct contribution from your IRA handled by whatever investment company platform your funds are on. They'll send the money directly to your designated charity. And these count against your required minimum distribution, but they do not hit your tax return as taxable income. And you can gift as much as $100,000 a year. So I did a really quick example just to kind of show the impact. Hopefully you can see this. So this is a pretty typical retired couple receiving 60,000 Social Security, taking 55 grand a year of IRAs, about $30,000 of interest, dividends, and capital gains. And this couple have decided they're going to go ahead. We sure like to think most of our clients are done with their mortgages by this time. So in my example, I just had no mortgage interest. But as you can see, they're far away from the $31,500 standard deduction anyway. They're sending $10,000 of donations out to their favorite charities. And because they're taking the standard deduction of 31.5 here, they're literally getting no marginal value from this donation. On the other hand, if we take that same couple and we do a $10,000 distribution directly out of the IRA, so they don't get the 10,000 itemized deduction, which they weren't using anyway, only 45,000 instead of 55,000 of IRA income hits their tax return. And you can see their taxable income down at the bottom is exactly $10,000 lower. So this is a 12% bracket taxpayer. That would save them a little over $1,200 in taxes.
I just want to jump in real quick. For those that do itemize and do a QCD, it's not includable in your income, but it is also not allowed as a charitable contribution. So you don't get to double dip on that. So I just wanted to throw that in there.
Right. But so if you have a very large IRA and you're worried about triggering phase outs, or you're worried about hitting IRMA and having to pay more Medicare tax, you can circumvent some portion or all of your RMD up to 100 grand by making donations directly to a charity. So we love Roth conversions. Obviously, a Roth conversion is a taxable event, so it does require a lot of forethought. You're basically volunteering tax early, and you're implicitly saying, I'm going to give the government tax dollars today because I happen to believe that these dollars in this Roth, which will, in theory, if we behave properly and follow the rules, never get taxed again, will compound and incur, we'll have far better value than if I had left it in the IRA and pay tax on it later. I really like this when we have families with substantial assets and we're comfortable that IRAs are going to go to the next generation. Because what that means is you're paying tax early. That's never good. But you get tax-free appreciation in those dollars in the Roth for the rest of your life. Presumably your spouse's life, because they'll normally be your primary beneficiary. And then if they leave it to your children, under current laws, your children then still have 10 more years, notwithstanding RMDs, which would be relatively small, to get those dollars out. So if you're relatively young, if you're my age, 60, and you're lucky enough to live a while, it could be 30 years of compounding, 25 years of compounding, before your kids have to start worrying about taxes on them. There are any number of websites out on the web that help you look at IRA to Roth conversions, they require a bunch of assumptions, but I always encourage people to play with them a little bit. We will typically use a couple of them to sort of vet out what we're thinking, but they're pretty good. And then finally, for our clients that own businesses with either very few employees, where there's a disparity in age between the owner and their youngest employee. In a perfect world, you have 5 or 6 employees and one 25-year-old, and you're in your 50s or 60s. Cash balance plans, when married with a 401k plan, are an amazing retirement plan. Even better if you have no employees and you're either just a single individual or you and your spouse are the only 2 active employees inside your business. You can put substantial dollars in these cash balance plans. We just, in the end of 24, closed a cash balance plan for a small business client of ours that we started about a decade ago. We closed that and rolled it into an IRA, which is ultimately how these things play out. Our client deferred slightly over $3 million in taxes $3 million of contribution, taxable income over a decade. And when that thing rolled out, it was over $4.5 million. So obviously a high income person, but you can really use these strategically to kick the can on taxable income if you're in a high bracket. And you think that as you distribute it out, you'll be in a lower bracket going forward.
Okay, just a couple of reminders. Currently, they say there is no wash sale rules for digital assets. So basically, you can harvest losses and then immediately repurchase the same position. There's not a lot of guidance out on that yet. So we still feel like it's safer to wait a few days before you repurchase the digital asset. Portfolio loss harvesting in general, your stocks, if you sell losers to offset some of your gains before the end of the year, you need to wait 30 days before you repurchase that stock. Otherwise, your loss is not going to be available to offset the gain. Then just some reminders that we always remind everybody each year, have a will and a living trust in place. Anybody can now get an identity protection pin from the IRS. And basically that helps with fraud. It prevents someone else from filing an income tax return using your social security number, because they have to have this special IPIN in order to do it. But a caveat on that is once you get an IPIN, you have to get it every single year. So it's not like just a 1-year thing, as you've got to continue to get it. Gifting, if you make direct payments to an educational institution or to a medical provider for somebody else, those are not considered gifts that are subject to the annual gift tax limits. And for the education, it's only for tuition. So what are the gift tax rules? You can annually gift to any person $19,000 a year without impacting your gift, without having to file a gift tax return or impacting your lifetime exemption credit. And what that means is if you're you and your spouse can each give $19,000, so you get $38,000 per year that you can give to a child, a grandchild, whoever you want, and not incur any gift tax filing requirement. Once you go beyond that $19,000, then there is a gift tax filing requirement. And again, depending on where you are in the utilization of your lifetime exemption, more than likely you're probably not going to pay gift tax on those gifts, but you do need to file a return to show the IRS that you have used up some of your lifetime exemption. We encourage you to review and update all of your retirement plan beneficiaries to make sure that they are who you want. And again, keep in mind the differences in who you pick as a beneficiary. If you pick an individual that's your spouse, they can basically roll it over to their own, and they don't have to take it out within a certain period of time. If you leave it to a child or somebody else, they generally have to withdraw it within 10 years. There are some exceptions. If you have certain types of beneficiaries, then they might be able to take it out longer. But if you leave it to like a trust, or you don't leave a designated beneficiary at all, and it goes into your estate, those are typically have to be triggered right when you die. They have to be distributed within the year that after you die. So kind of keep those things in mind when you are doing those. Again, another important reminder about wills and trusts is every year we work with people, and great, they set up this revocable living trust, but they then fail to transfer their assets into that living trust. So it's really important, if you set it up, the trust, that you transfer those assets into the name of your living trust. So anything with a title, you want to transfer into the trust. And even the things that don't have a title, you can put a paragraph within your trust instrument that says, these items are going to be considered to be in my trust. So that you can pretty much get everything into your revocable living trust before the end of the year. The pitfalls of not getting that done is Arizona's probate limit is not very big. It's like $75,000. Probate is generally a long process, and it's an expensive process, and it's really, not something you want to drag your beneficiaries through. Use of the lighting, here we did that. Okay, so then real estate owners, if you want to take advantage of the QBI deduction and avoid net investment income tax, which I don't think we talked about in here at all, but it's been around for quite a while, you need to issue 1099s to people who provide services for your company or for your real estate. So those of you that have like rental houses and you pay a landscaper or somebody to come fix things, you need to issue the 1099 to them. Otherwise, technically, you are not allowed to take that deduction for those expenses.
Yeah. So the net investment income tax, for those that don't remember, is the additional 3.8% surtax on top of, for anybody who's got total income of 250,000 if you're married, or 200,000 if you are single. So that would apply to all passive income. The reason why we need the 1099s is we're going to take the argument that this is not a passive activity, it's an active trade or business. The IRS position is if you don't issue 1099s, then it's not an active trade or business. By default, it's a passive business. 3.8% isn't a big deal on rental profit year after year. But if you happen to sell a property at a substantial gain, 3.8% may add up to a lot of money. And if you don't have a history of 1099s and you get audited, they're gonna blow your NIIT deduction out of the water. Holy cow.
And so we finally made it to the end. And with that, we want to thank everybody for your attention and for joining us this afternoon, and open the floor up to any questions that you guys might have.
And I'm gonna put the Maggie definition up.
Feel free to drop any questions in the chat, in the Q&A box, or raise your hand. The Zoom hand, of course. Well, I take it that was a sign that you guys were very thorough.
Cool. Well, if there's not any questions, we thank you. Oh, hang on a second.
Oh, here we go.
Okay, we do have one question in the Q&A, and I don't know if can people see the question or not?
Why don't you read it for them just in case?
Yeah, the question is the $6,000 senior deduction for seniors only if you're getting Social Security? The answer is no. If you're one of those people who is over 65 but have made the decision not to start Social Security till, say, age 70, like many people do, you are still eligible to take the $6,000 deduction. They're calling it a no tax on Social Security. The reality is it's just a $6,000 deduction per person as long as you don't phase out. Yeah, we will create a PDF of the slideshow. We will share with the Rose Law Group. For our clients, we will put a copy of this recording on our website along with a copy of the presentation. And so you're certainly welcome to take a look at it. And if you have any questions, let us know. We got another question. So Yeah, so the question is, can we start a Trump account for a grandchild who was born before 2025? I think the answer is yes. We'll get further guidance, but I don't think this doesn't appear to be limited to people born in 2025 forward. 425 through 28 are the only people eligible to get the $1,000 seeding from the government. But you can, if you have a child under the age of 18 born before 2025, starting in July of next year, because accounts will not be available till then, you could start feeding that account 5,000 per year. Any other questions?
Yeah, it looks like we have one from Charles and Linda Thompson. I'm going to go ahead and allow Charles and Linda to ask their question over the mic.
Sure.
So I've given them talking permissions. Charles and Linda, go ahead and unmute yourselves when you're ready.
Wondering about
Excellent.
the contact information to get the slides.
So yes, I have all of your guys' registration emails from the participants, so I'll be able to make sure you guys get that to you either by an email. We could also upload to YouTube and etc. But yes, don't worry, we will make sure that everybody who registered will have access to that.
Perfect, thank you.
Thank you.
Thank you. All right. Have a couple more questions in the Q&A box.
Associated with.
The last one, okay, we're getting them fast now. So slow down for us a little bit here, folks. I don't know who Craig Ware is. So the question was, are you associated with Craig Ware? We're not. I don't know who that person is. I'm sure they're very, very nice. We have a question. Does the law address whether or not we have to register LLCs? So this goes back to the Corporate Transparency Act. Shruti was great enough a couple years ago to do an entire presentation for our clients on the subject. That is now dead. It got blown up in the court system. And for those of you that registered, it's sitting there somewhere doing nothing. And for those of you that haven't, it's a non-issue any longer.
Yeah, the only people who are required to file are foreign corporations who are doing business in the US.
And then the last question, if you farm land and sell to a home builder, there are no 1099 expenses. So if you're reporting your income on Schedule F as a farmer, I think by definition, you're in the trader business of farming. The land would be a capital asset of your farming. And so we would certainly take the position that that's an active trader business and that asset upon disposal would not be subject to the net investment income tax.
Fabulous. We also have one more question from David Dubois. I'm going to go ahead and give you the mic, David. Go ahead and unmute. Alrighty. Feel free to ask your question. David, you have the mic, but we can't hear you if you do have your question. Oh, all right. Well,
He made a comment that said, but there are some requirements to file with Arizona. We were strictly just talking about the BOI registration with the government. Arizona does have, your annual Arizona Corporation Commission filings. I don't know if that's what he was asking or referring to, but you do still have those Arizona filing requirements.
Yeah. So we have another question also. I own my own professional business. Can I have my business pay my student loan? In this case, because you own it, the simple answer is no, because you don't have any other employees and you're not paying for other employees. You'd have to dilute yourself to a substantial amount. You're welcome. Any others?
I don't think so.
Good.
Excellent.
Well, it's exactly 4:30. So by some miracle, we managed to get it done within the time frame. Thank you, everybody, for participating. we certainly hope that you got some valuable information from it. Shruti, thank you. And Madeline, thank you for providing the infrastructure and helping us with distributing it and hosting it. It is definitely outside of our skill set. And
Oh, yeah.
we will get a copy of the presentation from the Realtors Law team and put it on our website. And our website is www.splavercpa.com.
Excellent. Thank you everyone for joining us, and thank you, panelists. We'll go
Thank
ahead
you.
and conclude.
Thanks, Jen. Thank you.
Thank
Good night,
you.
everyone.
Bye, everyone.